car loans is the number one debt that keeps people from being homeowners. We see this time in, time out. And what happens is people just don't realize the impact that a car payment has on them qualifying for a mortgage, right? Whatever it be. The same thing applies to condos when looking at HOA dues, when looking at property taxes, and sometimes even homeowners insurance comes in at a higher amount than you initially thought, throwing off all the numbers for what you can qualify for. That's why it's so important when you go through that pre-approval process, okay, for whatever loan type that you pick, that you just let the lender know if you are planning on doing something, especially around buying a car or the types of properties you look at. That's why it's important, because they might say, well, with a single family property, you qualify for more or less, just really depending on all those factors. Now, different loan programs look at things differently, okay? You may have conventional, FHA, and you have VA loans. Now, conventional and FHA look at primarily debt to income ratios, which is going to be your gross pay, and they're going to divide your credit liabilities minus self-reported liabilities and your proposed mortgage payment, and then they divide that by each other. And typically conventional loans are going to be capped at 50% debt to income ratio. And then you have FHA loans, which are going to be capped at 55%. And then VA has a little bit different system. They look at both debt to income ratio and residual income. So they actually allow, I mean, we've seen as high as 75% debt to income ratio, because they look at net income. So just a different calculation on that. So kind of be mindful of that. And then if you have a spouse on there, not on the mortgage, and they do have a car loan or some additional debt, it doesn't affect you unless you're in a community property state, then it does. So let me break down some examples of what I'm talking about. This is where I think you guys are going to be like, holy cow. This is all for educational purposes. I'm using a 7% interest rate on mortgages, just kind of as like, hey, this is where the market's at today, kind of roughly blended between all the loan products that exist. And then we're also going to look at a 5-year car note for these 3 examples. And obviously you could play around with some numbers when using a calculator. So a car payment, I'm going to start with high numbers and go lower, so don't worry. So a car payment of $1,597 equates to about an $80,000 car on a 5-year term. In a mortgage, that basically is $240,000 in purchasing power. Okay, so for that same $1,597, you can either buy a $50,000 car or add $240,000 to a budget, or just buy a house or a condo for $240,000. Next example is a car payment of $931. Same thing with the mortgage. That car is a $50,000 car purchase on a 5-year term. That equates to a $140,000 mortgage. I think that's mind-blowing. So if you kind of think about, a lot of times people will think to themselves like, well, I can't afford being a homeowner, but you got a, $50,000 car. So again, we're going to go through some options that you might not be thinking about that affect you, because a lot of people can, the average car, it seems like is $50,000. Anytime I turn around looking, I'm like, holy cow, like everything is crazy expensive. And then a payment of $499 is about a $25,000 car. And then it actually equates to about a $75,000 mortgage. I think that's crazy if you think about it, because unless you're leasing a car well underneath that, it definitely has a big impact. So a lot of people disqualify themselves. And again, car loans is the number one thing that we see people disqualify, because hands down, people will come and they'll ask, hey, I want to get this loan amount. And then we'll look at it and be like, yeah, we could make it work if you didn't have the car payment. And it's always about if you didn't have the car payment. So make sure that you're budgeting and looking at the whole picture. So let's go through some options that you might have and some of the factors that go into all of this. Now, a lot of times, people really need a car or not is something you should be evaluating. Now, I get it. Like if you're living in a city, it might be a little bit easy, but if you got to commute, you got to commute for that. The other option that comes up is kind of the most common one, is looking at either trading that vehicle in or being able to just sell your vehicle and just buy a used car cash if you have the funds or if you make some money off the vehicle. I think a lot of times the challenge is that vehicles lose a lot of money just off the bat, and it's kind of hard to recover that money. That's why everyone's financial picture is different, right? You may have to spend actual cash to, let's say, sell a car, but it's still not going to equal to what you can do as far as purchasing power and purchase a property that, you know, potentially is going to be appreciating. Now, historically, that's how it's been, but there's no guarantees in life. We had that happen in 2008, 2009. Values went drastically down, but then they've obviously made up for it well now. Real estate's very cyclical in that sense. Same thing like interest rates, where they go up and they go down. If you didn't buy when they're low, you're going to have a better opportunity buying when they're higher and then refinancing when they get lower, especially if you get the VA home loan. It's a breeze to do an interest rate reduction refinance loan. So all of that is pretty good. But that's something like if you're in that process, right, of, hey, I'm pre-approved for my mortgage, I'm under contract. Basically, you're going from, you know, hey, I'm under contract to the time you close. So until you get the keys to the house, you can literally get the keys to your house, close everything, funds, and then go buy a car an hour later, and it doesn't affect anything. But it definitely has an impact for you when you're going through that process. Now, do people buy a car in the middle of buying a home or being pre-approved? Yeah, it happens. Life happens, right? And then we also work with a lot of active duty folks from overseas coming in. They're like, hey, I need to buy a vehicle. What are my options? But that's why, you know, a lender's going to look at your financial picture and be like, okay, based on your current financial picture, this is how we can structure your finances. You have a max payment of, you know, $600. So then it lets the client know, like, okay, I have some wiggle room on this, because then when you do that car loan, you're going to have to get all the paperwork, and you definitely don't want to be buying a car with financing a week before closing. That's for sure going to throw everything off and delay the closing. I would say it's better to give us 3 weeks or so, because when you close on the car, they have to update your credit report. All of it has to be done manually. So there's definitely a process to doing that. But again, you want to talk to your lender and be able to go through that. If you guys are interested, we help people across the entire country get financing and also connect them with realtors that know what they're doing. So a link in the description below if you want to schedule a call with us. And don't forget to smash that like and subscribe button to get more content like this. So let's talk about some other things that come with that. So if you are on a lease, it also changes things a little bit, because well, let me combine it with this other piece. So if you're at 10 months or less on your payment, not like you've paid down the balance to 10 months to kind of get around this rule, like if you legitimately have 10 payments left on your car payment. Now, if it's a regular loan for like a regular car, no issues, right? The lender can omit that liability against, they don't count it against your debt. Now, if you're in a lease situation, you have 10 payments or less, the challenge is that the underwriter is going to be like, well, they're going to have to get another car loan after they close. So what is the right answer to that? So, you know, we have this happening right now, as we speak. Someone's lease is ending on a client that's buying a house. But the thing is, they already have a vehicle paid for in cash, that they already provided all the information, that they have the title to that property and or title to the car, and we don't have to then count the payment against them. So those are all things that you need to think about. Same thing if you, another loophole, if you're a co-borrower, this is kind of a loophole in the program for most products, is that if you co-sign for somebody, just remember, by the way, that you're fully responsible 100% for that payment. So if they don't make it, it affects your credit, you're not getting off of that. So besides that, if you have somebody else that makes the payments for 12 consecutive months and continues to make those payments out of their own checking account, you're not on anything of theirs, and they can prove that with bank statements showing that they made the payments, then the lender can omit that liability. And that kind of also leads into that you're self-employed. Well, my car is my expense. Well, how do you actually expense it, right? Some people would just do a straight deduction off the taxes with no lease in place to their business, and the business is making the payments. They make the payments themselves. Then you're responsible for it. So a lot of factors to think about when you're purchasing a vehicle. If you guys have questions, please feel free to reach out to us. Again, just our link is down below in the description. Looking forward to talking to you guys. You have a great day. Talk to you soon.